So as people kind of get back in, let me quickly start off in terms of sharing some data for the benefit of folks who are already here and patiently waiting for the colleagues to join. So quick stats on the M&A activity in 2018. The global M&A market remained quite strong in 2018, as my colleague mentioned. Whether there's IPOs, anything else that's happening in the market, what we are sure is, with dollops of capital, the Swiggies and Oyos and the Baijus are already buying companies. So in that sense, we are quite clear that whatever 2019 is going to throw at us, M&A is going to be one part of the transaction ecosystem, which is going to be very strong. So looking back to 2018, in terms of the global M&A data says, it's around 4.1 trillion, and that's like the third highest ever for M&A volumes, right? And in terms of domestic deals within India, so there are obviously three types of transactions that happen. One is domestic, which is companies within India transacting among each other. There's inbound, which is like foreign companies acquiring Indian companies, and outbound, which is the reverse, Indian companies going shopping abroad. In terms of the data for 2018, domestic deals were very strong. The number is $57.3 billion US. That's more than double from the previous all-time high. That was in 2017, which is 26.7. Inbound M&A reached 55.8 billion, and of course of that 20 billion is just the Walmart Flipkart transaction, right? Outbound acquisitions by Indian companies reached an 8-year high at $13.4 billion in total deal value, and private equity backed M&A, the sort that we have in terms of exits, also witnessed strong activity. Again, Flipkart and buyout firms getting engaged and taking control in stakes in companies, $13.1 billion, and that grew 72%. So net, it's quite clear that with such a resilient M&A market globally, it's very important and actually imperative for entrepreneurs as well as fund managers to understand what makes an M&A transaction succeed, right? So I'll just give a couple of more minutes for people to stream in. In terms of, we have a panel which is very interesting mix here, and I think very, very balanced in the sense that we have two IT veterans, in terms of both somebody who's actually run companies for a long time and now founded companies, and within their companies reached a level of maturity where they are going in and already quite actively so in terms of inorganic transactions, which is obviously jargon for acquisitions. So we have then somebody from the private equity side who specializes in terms of acquiring majority stakes in these companies. So we're going to try and find from them what the different in terms of approaches between these two companies. And then we have three very interesting service providers, who are very key to this ecosystem in both enabling companies who, in terms of very crucial. So one, for example, is a transaction advisory firm. I'll talk about them. One is in terms of legal advice, and third, very interestingly, is on the cultural front. So as people welcome back, so I will introduce the panelists who are already seated on stage. First, we have Mr. L.C. Singh, founder and chairman of Nihilent. Gowri Subramanian, founder and CEO, Aspire Systems. Pravin Advani, co-founder and managing partner, SA Global Services. Sumit Sinha, partner, DMD Advocates. Yeshasvini Ramaswamy, Chief Product Officer and founder of Mnagenome, and Rajeev Agrawal, partner, Ambit, Pragma. Great. So these professionals that I was talking about who are helping to support this panel and joining us here, to lend their expertise, a few words about them. Pravin is the founder and managing partner, like I said, at SA Global. A bit about SA Global. It's a technology-focused investment banking firm that has advised many mid-market companies make successful acquisitions and seasoned founders to help exit their businesses. In keeping with its deep focus on the technology sector, SA Global has presence across the US, specifically Silicon Valley and India. The firm specializes in bringing growth capital and strategic investment stroke M&A advisory capabilities to mid-market companies, which he defines as $5 million to $100 million revenue, firms in the technology, software services, IT services, and product engineering services, as well as the mobile space. SA Global has successfully helped mid-market technology firms grow through acquisitions by engaging them on the Growth Catalyst program, a unique model towards creating win-win situations for maximizing returns on an acquisition. While much of his career has been international, including especially in the US, SA Global and I presume Pravin, his own India headquarters is very much Mumbai, right? So there he is very much available for someone to reach out to locally as well. Mr. Sumit Sinha, partner and DMD at DMD Advocates, has come down from Delhi. That's his base. Thank you, sir. And DMD Advocates is a full-service law firm with expertise and decades of experience in 5 core practice areas: litigation and dispute resolution, corporate, taxation, regulatory, and intellectual property rights. The firm has working relationship with global law firms and has been involved in significant international transactions and deals, particularly for US-based companies. DMD has a pan-India presence with principal offices in New Delhi and Mumbai and associate offices in Bangalore, Chennai, Cochin, and Bhubaneswar. Pretty much covers the country. Ms. Yeshasvini Ramaswamy, founder and chief product officer of Mnagenome. Quite appropriately, she's being a technology-led company, is based out of Bangalore. So thanks for coming up, I guess, right? So as their tagline, which you note here, says Mnagenome is where culture meets AI, right? So while M&A is right here in front and center in the panel, as well as the brand name, I will let her describe how her products, make culture and AI apply to this context into the world of transactions, right? So more detailed bios of all the panelists are available as part of the event material. Now that, we have successfully established quorum, I guess I will start with the panel. Great. So I would love to begin with you, Mr. Singh. Nihilent has made 4 publicly announced, acquisitions. So in terms of, the strategy or the key drivers behind these, can you tell us, what was the thinking? I'd love to hear from you on those.
Hello. Good afternoon, everyone. Before I tell you the answer to the question, I want to just tell about Nayland itself. I have a background in technology. I was 18 years with TCS and 2 years with Zensar Technologies. And 2000 I started Nayland. And just to tell you that 1 year back we changed our name from Nayland Technologies to Nayland Limited. Because we play actually in integrated change management. And since technology is a major driver for change, so it's only opportune that when you are implementing technology, you also look at the people and process side. And that's what Nayland is trying to do. So in that process, basically, when you wanted to differentiate the company, number one, you can organically grow so much. But then there are competencies which has to be augmented. And having reached a level of size where we had some money and we could kind of invest from our own pocket, then we ventured outside. And that's where we met SA Global and told them our requirement. Requirement were very simple, actually. Number one, complementarity in the skills. That was very important. We have developed a lot of skills in-house organically, coming from our background. But we also knew that if I look at the vision where I want to be, then there were gaps. So those gaps had to be filled very clearly. And that's what we told them, point one. Point two was that the management team which we acquire must continue, because in our business, it is the people's business entirely. You are not buying the company for revenue. It is always for the competencies and the continuation of the management teams. So second point was there. And third point, initially we started the company focusing in Africa, but then we wanted to go global because we had the wherewithal and the competencies, and we were looking for acquiring companies outside of African market, namely in India, in America, and in other markets. So in last 4 years, essentially, we made 2 acquisitions in America, largely in the AI and machine learning, the BI and that kind of very specific machine learning algorithms. We bought a company's subsidiary of Moody's Analytics. So through that also we got expansion in India. So we set up our center. We had a center, therefore, in Calcutta, Chennai, Pune we are headquartered in. And so the footprint increased. So what we have achieved actually is that we have now presence in America in almost 6 cities. We have in UK our own operation, Australia. And as we go forward, we keep looking for expansion of business in those geographies as well. In addition, as we move forward, since we wanted to be a consulting centric change management or technology transformation company, we adopted design thinking as a core philosophy. So we have one of the most state-of-the-art labs in Pune. Then we replicated that in Africa, and we are replicating that in 6 different countries. So what we are looking for is combining basically the management consulting part, the consumer induction into the strategy, and technology enablement and experimentation. One of the most crucial point was that how do we look at the cultural integration. So we're very careful in looking the quality of people. What is their vision? What is their dream? Is it that they're just trying to exit? And those are the companies we're not interested. So we want a company which can add value and people who are looking for a partnership or a joint dream to be pursued. One thing also we discovered that whomever we acquire, they are in love with their brand. So it's always a challenge, how do you cope up with the integration process? And so that's what we've achieved. At the end of 4 years, I think we have integrated all the 3 companies specifically. What is in the process? So we're just about to complete that acquisition practically. So that's where we are. Any question, I would be very pleased to answer.
Thank you so much. It's fascinating. So Gowri, we'll come to you. Aspire has made half a dozen publicly announced ones at least acquisitions, and 2 of them was just earlier this month, right? So, so what has been your experience? Is it similar to Nihilent's? Please give us your thinking and the transaction details.
Sure. So first of all, it's great to be here. Good afternoon, everybody. I think our experience is very similar to Nihilent. I think to some extent the companies are very similar as well. Just to give you a one-line introduction to Aspire, essentially we focus on product engineering services and digital transformation activities primarily for banks and retailers. So that's what we do. And I think one of the key, let's say, strategic objectives for us is to continue growing as a company and to be there for the longer term. So a company like us, there's always options to exit the company, right? We could sell to somebody else, and that option has always been open to us for the last 10 plus years. But we made a call that we want to, having reached a certain size and scale, we want to continue building the company. And if we need to continue building it, I think you need to do it through obviously strong organic growth, but I think also a fairly strong inorganic growth or M&A growth. So we decided that we need to be good at M&A apart from driving organic growth. So if you look at Aspire over the last 5 years, on average, our CAGR would be annual growth rate, accumulated compounded growth rate would be about 27-28%. And to maintain that kind of growth rate, I mean, we aim for about 18 to 20% organic growth and about 8 to 9% inorganic growth. And 8 to 9% inorganic growth is typically on the higher side. I mean, if you see companies would aim to have typically about 5% inorganic growth. So because there are two things we are attempting to do. One is we want to keep the growth clock ticking at about 25 to 30% every year, because we are, okay, I mentioned we are a product engineering company, we are a digital transformation company, but then we are in a competitive space. India is very good in software services, and we are another software services company. So how do we differentiate ourselves? I mean, of course, you differentiate ourselves by technology and people and so on, but I think the other way we need to do is to continually differentiate ourselves by trying to grow faster than the industry. And the industry, as you know, grows about 12, 13, 14% a year probably. And our aim is to double that. And that's what we really aim for, and aim to do that through a mix of organic and inorganic growth. And thankfully, so far, we've been able to maintain that. The question is, can we continue doing, can we continue doing that going forward? So that's, that at a high level. We want to build a company for the long term, scale the organization, and hence drive that through a mix of organic and inorganic growth. Now, in terms of what we look for, essentially, there are a set of areas which we have defined as focus areas for us. So, for example, as I said, banks and retailers are key focus target markets for us. So then, but we are new into retail. When we were new into retail, we said, let's go out and make sure we get somebody who has some experience working with the retail industry. Because that, whenever you go to a retailer and talk, they're going to ask you what's your previous experience, what work you've done, references, etc., etc. And it's very hard to crack that puzzle. So we then set out looking for a small retail consulting company that can be part of us. So it's very defined by, what we want to do. And then we go out and we look for, what matches us. For example, another example I can give you is our nearshore acquisitions. So we felt that servicing, customers in US and Europe, which is our biggest market, from India is great, but it's also good to have a presence nearer to them. So we said we want to have something in Eastern Europe. And so we went out and looked for something in maybe Poland and Romania. It took us about a year plus to do that, and then we finally ended up acquiring about a company with about 120 people or so in Poland, right? And that's again was defined by the fact that we wanted to establish a nearshore presence in Eastern Europe, and we're doing something similar in North America as well with identifying a company in Mexico. So it's very much driven by the areas we want to go at. The last, and then looking for companies around that. The last thing I do want to make sure that I mention is that we are very, we are very conservative in terms of what we look for. Of course, we look for great fitment, cultural fitment, continuity of customers and revenues and so on. But we also want to make sure that we don't overpay, right? I mean, because we are not backed by private equity, we could raise money if we want, but we actually do it through internal accruals and we do it through debt, which means we have to pay it back the hard way. So we want to make sure we don't overpay, because you enter at the wrong price, I think that is kind of a recipe for it not working well. So we want to make sure we go in at the right price, and sometimes that actually rules out a lot of targets for us, but that's the cost of trying to stay patient and make sure we can build it for the long term. And the other aspect is we're always looking to make sure we can tightly integrate the companies. Our objective is not to buy something and just leave it out there and be on its own, not just like a balance sheet or P&L kind of acquisition. It's really an organizational integration. So we aim to bring the companies together. It takes some time, as you mentioned. People are very attached to the previous company. They work for the logo, etc. So you have to do some of that transition carefully, but we aim to do that over a period of time. So some of the key aspects are we don't want to overpay. We want to make sure it is in the capability areas we're looking for, and we want to make sure that over a period of time we tightly integrate the organization. So these are these are some of the things that we look for, and we will continue looking for. So in terms of how we go about it, we have a small in-house M&A team where once we define what we're looking for, there's a small team that goes out and maps targets, and we talk to them. But we're also very actively working with investment bankers. They know that we are looking to buy. So if they come across some companies, or rather they are representing company, they always bring it to us and give us a chance to look at it and see if we can participate. But so that's at a high level. I touched upon a few points. We'll be able to add answer more questions if it comes up.
Wonderful.
So thank you.
Thank you. So we had a Pravin, over to you. We had a Pune view. We had a conservative Chennai view, right? So I hope you're going to be all aggression. So there you go. So strategic fit, right? So that's a key word that it gets often used in the context of M&A. So in the transactions that you've been involved with over the years, and we know you've been part of buyout shops as well, how much of a factor does this keyword, the buzzword, strategic fit between the target and the acquirer play?
Great, thank you, Arun, and good afternoon. Great to be here. Certainly, I can say, for us, Arun, it's very fundamental to the way we approach deal making, right? It is extremely important in our view to kind of almost start with the strategy. So way before you start looking at deals opportunistically, I think it's very important to kind of put a strategy in place which is more inside out. Where are you today? What's point A? And then sort of what is point B, where you want to go with respect to the acquisition-led growth and what your game plan looks like. We really want to start looking at some of the thematic programs around the M&A strategy, as well as looking at what sectors, what multiples do you want to acquire at, and then once the strategy is sort of in place, you want to at least be able to look at what the gaps are that you're trying to fill out. At least from what we've seen, you want to have a very streamlined process where you can say no, a quick yes or no to deals very, very quickly. So the deals that don't fit your paradigm ideally should get dropped in a matter of days or hours if you can, right? And if you don't have that process in place, a lot of times we've seen that it'll take maybe 2 months or 3 months of the CEO and the CFO team and the management team's time, which is something that must be avoided, right? So I think that's where sort of this discipline and target search process comes in, which I think we had Gowri talk about as well earlier. So we think that's fundamental. Understanding what the synergy value is going to be in any deal, and where are you going to see synergies early on in your due diligence process, and then thinking through how are you going to integrate the company in terms of operations, and where are you going to be able to realize those synergies is also very important. In general, the higher the synergy value, if you can quantify it, the better the strategic fit is what we've seen in most deals. And therefore, if you have that paradigm, you probably have a higher probability of success, in terms of the deal that you're trying to drive. And there are different ways to arrive at this. I mean, one is also looking at complementarity between the target and the acquirer, and running a relative SWOT to get a sense of, how do the target and the acquirer complement their strengths and weaknesses. We've also, seen situations where we might run like a 4C sort of a model in terms of understanding the capabilities, the competencies of both the target and the acquirer. What sort of commitment or roadmap do we have with the founding team? How much of an integration, is realistic? What makes sense, what doesn't make sense? Certainly, if I look at the two contrasting approaches, in one scenario that we were involved with Nihilent, we actually acquired a company where the brand and the founding team both were retained without necessarily, any integration for more than 3 years. And that's because that brand actually meant something and it had some value for, the customers of that business. So a lot of times it's about, looking at what pace of integration makes sense and where the risks are going to be if you try and integrate too quickly, right? So, there's no one set sort of formula for finding the right strategic fit. I think it also depends on, the organizations, what sort of a process, you drive with respect to the M&A process as well as the integration process. So I can give, a couple examples. I mean, one is certainly we work with Mr. L.C. Singh's company, Nihilent, where you do have a clear thought process, a strategy, and a full-fledged, integration team in place where you can start driving these things in terms of a 100-day plan. So what happens post-deal is also important, and that's something that companies have in place if they're a successful acquirer and have been doing this for some time. At the other end, we're working with a cloud technology product company, US acquirer. They're at about 25 million in revenue, but they made 3 acquisitions to get to 25 million from 10 million. And there, it's largely, their chief operating officer who pretty much does everything from strategy to the target search process to working with our team to define, how they want to start evaluating a certain deal and how do they want to take it to conclusion and so on. So it really comes down to, in both cases, both have been successful. So they've done, for a company that's 25 million and has done 3 acquisitions, integrated those companies as a product company, it's a reasonable, success story. I think it just comes down to, experience. I think as we heard from both Gowri and from Mr. L.C. Singh, staying at it, and then I think, being able to really incorporate as many of these practices to reduce the risk in terms of the integration especially. So,
Thank you.
Thank you.
That was very useful. So this is really down to Rajeev now. So there is an entrepreneur in the audience who wants to sell his business, and neither is Gowri going to overpay. And so we know from Pravin as an advisor, he's not going to let Mr. Singh overpay as well. So please tell us that as a buyout firm, you will overpay at least for the right businesses. So jokes apart, the point is, why should this entrepreneur who's kind of trying to exit the business approach, strategic buyers like these 2 gentlemen versus a buyout shop like yours? What is the difference in your approach?
Sure. In fact, I'm going to add a different answer to that question too. I'll give you the pitch that an entrepreneur should give to us. Ideally, I should not be making that pitch. We are used to receiving that pitch. But nonetheless, and most interestingly, I'm going to tell you why we are not going to buy your company. That's going to make it interesting. Okay? So, first, there are principally, I would say, 4 reasons why you may think about selling to a financial investor. The first is really your own motivation. It could also be family. The next of kin is not interested in part of the business. You are tired, you are fatigued, you are lonely, you've been running a company for too long, you don't have, great friends who can advise you, and you are thinking, perhaps this is the time to monetize. You want to monetize? Private equity guys are one particular target which is available. They are easier to get to compared to strategic investors because they'll ask fewer questions which are operational in nature, and perhaps that's also the reason you should talk to them. Second is really people. What we have seen, I come from a small, medium, conventional businesses buyout background. I don't buy IT companies. Okay, so IT companies are of a different nature. There is a degree of professionalism around them. But if you were to look at conventional businesses, logistics, media, consumer goods, stuff like that, healthcare, you'll typically find that entrepreneur-run companies are a little shallow in terms of the amount of management depth which is available in them, especially the small and medium-sized companies. And it is not because the entrepreneur does not want to attract people. They just find it difficult to sell their companies, their size. There is a general aversion among professionals to go and join small, medium-sized businesses which are family-owned. They would rather work for large institutional businesses, be very secured in the thought that, I can work here for a long time and I'll get the next best job if I'm graduating from one company to another. So you have shallow management and then you are struggling. You're not able to run the company, which means that you are trying to run the company on your own all the time. Well, perhaps that's a time you should start thinking about selling your business. Private equity guys are good. They'll pay you and they'll get you out of the business. Third really is systems. We have generally observed that the systems that are there in entrepreneur-run companies are far from what you would find in institutional companies. As investors, we always berate that fact. then, you don't have those systems and you don't have governance, and these are things that you keep hearing about all the time. So there is a degree of truth in that. It is not entirely correct. But the fact remains that most buyers, they come from a very institutionalized approach to buying and running a company. And there is a gap. So they come in, look at a business, and they'll say, there are gaps missing. You as an entrepreneur realize that if I'm going to sell this to a strategic investor, they will point out these gaps to you. They will make it difficult for you to sell. When you sell to a private equity investor, you know that he is buying to sell it later, which means that he will have to necessarily fill those gaps. And that makes it a little more amenable to be able to pitch to private equity guys. And the fourth really is capital. So you want capital for growth. You are looking for various options. So debt is not so much of an option after a point in time, especially if you are small and medium size. And you want to raise equity. You worry what will happen if you dilute. You worry how the shareholders agreement is going to work out. So you might as well sell. This is perhaps your time. You put all the factors together and you say, maybe it is meaningful to transfer control right now. Me becoming a minority, probably exiting the business altogether. That's the reason perhaps you talk to a private equity guy. Broadly 4, okay? And there can be many others, but it will fall in one of those 4 brackets. Perhaps I should also tell you why we will not buy, because that's the more interesting piece, which I can speak from my experience. And they again relate to these very factors. The first, as Pravin highlighted, is when entrepreneurs approach us and tell them that they want to sell, we become a skeptic right at that point in time. Why are you trying to sell? Why can't you run your business? Is there something wrong with it? Is it indeed really going to grow? Have you run out of strategic options in the company? So we become a skeptic at the moment we hear the word sell. Now, I am a buyout fund, but I don't want to hear that story at all. I would rather like to have an entrepreneur sitting inside. That's the first point. Second, there is a big difference between funds, the way they operate, and their capabilities, and the way entrepreneur-run companies operate, right? Let me give you an example. As financiers, as investors, we are used to certain cost structures. When we run our own businesses, we are in some form entrepreneurs in our own right. We run a small fund, we have our own teams, we have to build that. So we are used to certain cost structure, we are part of the financial services industry. I can tell you here today that there is no other industry out there who has a cost structure which is very similar to a financial services industry. So an analyst, which is the starting position in a financial services company, will get paid 25 lakh rupees a year. A vice president in an entrepreneur-run company will get paid that kind of money after 20 years. We just cannot relate to the, if I may be pardoned for using the phrase, intellectual depth which is available in an entrepreneur-run company. We just can't find it. So we are extremely scared. What am I buying into? And this guy who's trying to sell is going to go away. Will I really be able to build that depth? Something we really worry about. So that's the second reason why we will walk away or be extremely wary of buying. Third, being financiers, I will also talk about some financial aspects to the business. Let's look at the P&L of any company. My experience tells me that after buying a business, the gross margin which was there on the P&L on the day we bought and what it is going to be 1 year later is going to be entirely different. And it's going to be lower. And this has to do with operational practices. Let me give you an example, real life example. Let's take a logistics company. And you can ask me about other companies and I'm happy to give you my experiences. If you look at a trucking business, right? There is a certain practice, an entrepreneur in the trucking business, which is a legitimate business, very large, operates a large number of trucks, would operate in terms of how they would compensate the drivers, which is really the variable cost per trip. They will have a system. They may pay cash. Usually they pay cash. They will identify a route. They'll fix a number and just pay that money. The company gets sold. It comes to us. We will say, hey buddy, what is this? No cash transactions. Everything has to be fully institutionalized. This doesn't work. So we will go and we'll stop that practice. Then we will create our own benchmark. Why are we paying 24,000 rupees for a Bombay to Delhi trip? No, I want to know the exact kilometer, Google kilometers. We are armchair analysts. The fact of the matter is we are never going to sit in a truck and go. We don't know how many tolls are there, whatever it is. But we will do some analysis and we'll come up with a fancy number. The moment we fix that number, the drivers are going to revolt. They will stop the trucks en route, start demanding money which you have to pay them. And willy-nilly you will find a few months later that you are paying far more than what you were paying earlier. Your gross margin has gone for a toss. First, which means that the profitability profile has changed. Second, look at the overheads. We will go in a company and say, hey, you don't have management depth, so I need to hire people. So we will begin hiring a CEO. Now CEOs are not like entrepreneurs. Entrepreneurs will take decisions on every single aspect of the business. From finance to HR to marketing to sales to operations, productions, even labor management, industrial management, environmental management, if you will. I have yet to come across in my career a CEO who can do all these activities. Entrepreneurs are special. So we hire a CEO, and then the CEO will say, for these 6 activities, I'm going to need 5 more people. So you are actually replacing one guy at 3x the cost and 6 more people. Your overheads will go for a toss. Now this is symptomatic what you will see in all kinds of companies. You will even see in technology, startup businesses, which are private equity funded. They will claim that they have a huge amount of cash burn, essentially because they have got a very weighty management team. We talk about unit economics all the time, and the unit economics usually stop at the gross margin level. Nobody's looking below. And that's where all the cost is really sitting. In a buyout firm, it becomes all the more acute because, we've got to manage that. Third example I'll give you. Financially, what happens in a company? We invariably find that on the day we bought, if the net working capital days were, let's say, 120 days. A very simplistic definition I'll take. Receivables minus payables, okay? Divided by revenue. 120 days. We buy the company, put in a management team, and suddenly within 3 months that number is 60 days. You say, buddy, what happened? You'll find that the professional manager is not willing to accept a single vendor call who makes a call to say, I want to collect. The entrepreneur can ward off all those calls. He can stretch your credit cycles. He can make sure that the money comes as fast as possible. Professional management teams do an extremely shoddy job at that. And this is the reality. So your receivables will climb and your payables will fall. So whatever you budgeted for working capital is going to be double, if not triple of that. I'm talking about real world businesses. This is what happened financially.
So Rajeev, you have another example to go with?
Sorry?
Are you giving another example of why you will not buy companies?
Yeah. I can go on, right?
So we are looking for a list of, companies that you want, right? So maybe if you want to wind up the point, I will let you. So, yeah.
So, the last point I'll make is that in buyout companies, one of the biggest challenges we have is decision making, which is, typically entrepreneur-run companies, entrepreneurs take decisions all the time. When we own companies, a lot of the decisions travel back to us. And we are not quite comfortable taking those decisions. So the important thing is that can we find managers who will feel responsible for owning up the company and actually taking those decisions. These are some of the broader reasons. Of course, I can go on. Happy to address any questions, take any specific examples as we move forward.
So we definitely will have time for that. So Sumit, will come to you. There's a willing buyer, there's a willing seller, and there are 2 lawyers in between, right? So typical M&A transaction is that way, right? So please tell us, in the recent, changes that have happened to the legal, and the last few years have been quite dramatic in terms of whatever it is, whether it is CCI, or we've seen a whole bunch of things, come in. So please educate us, in terms of what can trip up a transaction, specifically from a legal perspective.
So, honestly, there are many factors for which a transaction could fall apart, but some of the more critical factors which have actually existed forever are, and actually there are many, but I would pin down on 3 or 4. The most important one that comes to my mind is the mindset of the target or the promoters of the target. Rajeev briefly touched upon it. There is a huge gap between the expectation of the acquirer and where the target company really is. In terms of, especially, I would start with the due diligence exercise, for example. Now, due diligence typically ends up being one of the biggest deal stoppers, biggest plays the spoil sport in most deals. And the reason really being that what is enough due diligence really? Where does one draw the line that, okay, I have explored the company enough and I'm really quite satisfied with what I've seen. I've seen the books, I've seen whatever information the company has provided me. Where typically acquirers get uncomfortable is that the company would project a certain set of documents, will put up certain set of documents in the data room, but when the acquirers start digging outside of the data room in public information, SEBI disclosures, MCA disclosures, they come up with things and information that kind of comes across as a rude shock or a wake-up call that maybe this is not the right path down the line. Also from a target's perspective, especially in very IP heavy sectors such as maybe healthcare or maybe defense, it becomes a bit of a challenge as to what is adequate disclosure. Where does the target company or the sellers draw a line that I have disclosed everything that I had to without overexposing myself to maybe a competitor or a possible competitor if the deal doesn't go through. So yeah, due diligence becomes a critical aspect. The second big issue that, and this is more relevant from a foreign acquirer's perspective, is they're really scared of the enforceability aspects of contracts in India. It's one thing to have robust reps and warranties, indemnities, but when you really go down to a situation where you have to enforce the indemnity provision, does it really work? How does it play out? It's not like you'll get up and say that, okay, there's this huge tax claim that has come up from which relates to the period prior to the acquisition, so you need to pay up. No, nobody's going to just raise their hands and say, okay, I agree, and here's your money. So it becomes a bit of a challenge, and it kind of ends up in a dispute between the acquirer, and especially if it's a situation where it's a part acquisition or a majority acquisition, and the sellers still are still within the system, and they are minority shareholders still holding a chunky part of the shareholding, let's say over 25% or 35%. So when the two partners start disputing on an aspect, then working together becomes a problem. Then your board doesn't function effectively. Matters which are reserve matter items get delayed. There is no resolution on them. Shareholder issues get delayed. In a nutshell, the functioning of the company comes to a kind of a standstill. The third larger issue that we typically face when we are kind of acting for the acquirer is the mindset that certain small to mid-sized companies would have in terms of their regulatory compliances. They kind of treat regulatory compliances as an unnecessary waste of money. And when you kind of go and explain that to them, they get extremely defensive. So it's like a friend and a foe situation, that when you're acting for the acquirer, you are the enemy, and what you're telling them is not right, and they have 1,000 reasons to justify why certain non-compliances exist. But when you're acting for the sellers, they kind of take your advice seriously and look to rectify, especially in a vendor due diligence kind of a situation. So those are kind of some of the key issues because of which deals fall apart. But having said that, I would think 2018 has been a robust year for M&A and private equity transactions in India, as you rightly pointed out. The political uncertainties and Brexit and the trade wars aside, 2019 also looks quite hopeful.
Thank you so much. So I'll come to you, Yeshasvini. So, before throwing open, for questions to any of the panelists. So Yeshasvini, it's kind of very interesting. Like I mentioned, you are leveraging artificial intelligence to establish the culture fit, right? So between the two organizations that are proposing a transaction, not even already there. So three-part question to you in terms of, one, please tell us some of the highlights of how AI is going to replace some of these folks on, how your product is going to do that. Two, more seriously, on who exactly is your target user? Is it the two transacting CEOs or CXOs at the two transacting, companies? Do advisory folks also use your product? So that's, part B. And, so in terms of, and three, to the gentleman on your left, do you apply to private equity at all? Or is it M&A only or M&A PE, So, right. All yours.
Wow, 3 questions to round up this. Thank you, Arun, and good evening, everybody. So we are very excited from the results that we've seen. So what we've put together is an artificial intelligence platform that does a very deep dive into culture and people. So just to give you a few statistics on the dimensions of the platform that we have, we study close to about 67 dimensions of human behavior. And from a pattern perspective, we have more than 9,700 patterns. So the hypothesis that we've built in is that any company is again seen as a personality. Now you may have a very aggressive personality, you may have a passive, you may have a conservative. So we tend to look at things from a psychology concept. The results that we've had are very interesting. Our data sets already has studied close to about 6,000 organizations across 56 countries. So what we bring to the table is new and refreshing from 3-4 perspectives. The first perspective is that we are now able to bring a single score called the cultural entropy score, which is a decision factor at a deal stage. So the entropy in simple words is nothing but the level of dysfunction, which is more than efficiency, in a particular organization. So the way we tend to see it is like a real estate deal. Location is everything, and you buy the flat for the location, but then the plumbing isn't working. What are you going to do with it, right? So culture is a little bit like that. So one is that we're able to bring it down to a score. So the higher the score, the more problems you're going to have with that particular target that you're going to close. So you may still turn around and say, fair enough, so what about it? So we say, we have gone back and linked financial data to cultural dysfunction, right? So now we're able to say that if your cultural entropy score is at X% in your organization, this is the monetized value that this company is losing month on month, day on day, year on year. So to the buy side, now they have a very tangible, clear number, data to go ahead and adjust the value. So maybe I had an X value, but I do this and I find out that, hey, this is not what it looks like. And so you can take decisions. So we kind of position ourselves both at the due diligence stage, and I'm refining that thought over the discussion that we had, and definitely on the post-merger integration stage. So one is we're able to get a score. Two is we're able to link financially, so we're able to guide on the value adjustment. And three, the kind of deep dive that we do on culture has given us fascinating results. For example, we had a very large Fortune group that spent a lot of money on integration and it was not moving. So we do something called an organization network analysis, just to give you an example. In very crude terms, this is the informal network / politics / cliques in a company. And we found out that even though they had well-defined structures, they had well-defined competencies, the vernacular language clique was kind of inhibiting change. So you had town halls where the leaders were coming and saying, this is the mandate, this is where we will grow and all of this, and say, for a want of a better word, since we're all South Indians, say he's a Keralite and I'm a Keralite, I'm just using an example. So I hear the leader and I'll say, what do you really think about it? And he says, yeah, all this is humbug, come let's go back to work. So, so there ends. So we've seen people, people is the only resource, Arun, in this whole equation, which are actually unpredictable. We're inspired work, we're also capable of non-cooperation. We're recently working with a bank, one of the largest mergers that's happened in India, where the issue that we are facing is of uncooperation. Very quiet, but they're not cooperating on the ground. It's quiet, it's passive, aggressive, non-cooperation. So this is where we were able to say, so what is the vision? We're data hungry. Whether we will replace them or whether we will make them look more intelligent, I don't know about that, but I think a few years down the line we will be able to safely have a set of deals. What we ideally would like to see ourselves are astrologers of this space. It's more like a marriage. I want to marry this guy, will the marriage be successful, what does the incompatibility look like, and what is the financial, so that's where we're kind of getting there. And it's interesting because I think we're also faced we're faced with cynicism also in a couple of conversations, because the tendency is money solves everything. Well, money is not equal to capability, and capability requires a certain different massaging to make that work. So it's been an interesting journey, and let's see.
Sure, wonderful. So on that note, I'm happy to welcome any questions. So specific to M&A, there's a private equity panel to follow. So if you're asking for funding, there's one gentleman there, but he's going to buy you out, right? So keep it M&A specific. The private equity panel will take care of your funding requirements. So I see a question go up right there at the corner. So first one. If this for anybody specific, please ask.
Sure. Hi, my name is Vikrant Vashne, Managing Partner of Succeed Venture from Hyderabad. I guess this is open for all, so you can decide who's the most suitable to this answer. This question is about acqui-hire, right? So in M&A space, obviously there is a new terminology of acqui-hire taking shape. It used to be pretty prevalent in the US market, but we are seeing that happening in India as well. Since I'm from the early stage investment side, we see a lot of these acqui-hire deals which are investor unfriendly. Most of the time they get whatever price for the team to go with them, but no price for the entity left, and hence the investors don't get the money. And I'm talking about even the largest possible names like Walmarts of the world also doing acqui-hire without any money going to the investor. What is the legal course in these, or if you have seen cases like that where acqui-hire route is used to bypass payments?
Sure. So I'll probably let the, so since you mentioned legal, Sumit want to cover that, and maybe Pravin, you want to chime in as well?
So essentially, most importantly, I think when you invest, your legal documentation needs to provide for an anti-acqui-hire kind of a situation, so that there is never a situation where the promoters or the management decides that gets an offer, an acqui-hire kind of an offer, and the entire team kind of leaves, leaving just the entity behind for you to not be able to do much with the entity. Very, very relevant in a sector which is human resource enabled, which largely relies on its resources to be able to function and run the business. So I think at the time of investment, you need to be very, very careful. The documentation, your investment documentation needs to be very, very specific, and needs to build in the relevant checks for an anti-acqui-hire kind of a situation.
One question on this context to you. Do you guys eat your own medicine? We see when legal teams, they leave entirely, right? So entire teams leave from one firm to another. What do you guys do?
I would avoid answering that question.
Go for it.
Great. No, I think Sumit, you covered most of I think the structure related points. I'd just like to add that it also comes down to what sort of share cap table do you have, what sort of tagalongs, dragalongs do you have, and what the structure is between the investors and the founders. And in most cases where we've seen acqui-hires, we've seen this really as technology buys between two portfolio companies of a venture capital fund. So that's the most common paradigm. We don't see otherwise, operating company with scale. So, I mean, I can lean to maybe either Gowri or LC doing an acqui-hire of a technology company that's venture backed because they may want to think through what value does it add beyond their own ability to build this capability internally. So I think just some points for, from what we've seen. Yeah.
Great. Thank you so much. So we have a long evening, so we have a lot of time over networking, immediately after the awards function. So we'll go for just one final question. So if you have, somebody who already has the mic, go for it, please.
Yes, sir.
Yeah, go ahead.
Hello, good afternoon. This is Subramanian from SS Makers, and we are a budding company, a small company just started. And Mr. Sagadevan is here. He is a young scientist, and he is going to be in the news very soon. And he has got a lot of innovations in the hand. And we need people to come up and completely change the world. He has got many solutions for many things. And as Mr. Rajeev told, there are a lot of problems for the entrepreneurs. So the entrepreneurs are suffering a lot. And I'm really thankful to Mr. Rajeev that he has pointed it out. And all the entrepreneurs should be appreciated. And I thank Ms. Yeshasvini also, since she's doing that lot of things for the entrepreneurs for the past 10 years. And you both can change the world, and we are there to support.
Wow. Okay,
and we have a lot of innovations. And recently we have started a
Sir, if you can get to the question, definitely they would love to have your support offline. We can grab some time.
Yes, sir.
Do you have a question?
Yes, sir. So my question is that, like we have the innovations and how to start about the startups. Starting itself is a big issue. Now we are talking in the very higher level. And to start with the budding companies, how they get the opportunities, like this is a very good interface. And we got the information and we have come here all the way from Coimbatore.
Wonderful.
So, like there are thousands and thousands of innovators available here.
Sure.
India is a very potential market. How to go about, how to get connected?
Wonderful, wonderful. So, Gowri, apart from, the CEO of Aspire Systems, is also a very active member of the Chennai Angels, right? So, I would like him to take this, where do entrepreneurs like him from Coimbatore, look out for in terms of startup capital? So please.
Yeah, I mean, it's a easy question, but there's no straightforward answer, right? I mean, I wish I could easily tell you exactly how to go about it. But I would really say just 2-3 things. One, I very strongly believe in this philosophy, copying from the Nike slogan, right? Just do it. I think there is no substitute for entrepreneurship apart from just believing in the idea, jumping and trying it out. I think that's where it starts. I think you just have to do it. I think a lot of people plan a lot, analyze a lot and things like that, which is all fine. But I think there's nothing like just jumping in and experiencing it and learning from it. Of course, you have to jump in, you have to try something and you have to constantly learn and change. So that's one aspect of it. The second aspect of it, I think is, and again, I'm just speaking from personal experience as well, I think it's perseverance. I think there's going to be n number of bottlenecks that come along the way. The only thing that can see someone through all that is just staying with the mission, staying with the goal, persevering, trying to break through those bottlenecks, etc. I think, just starting to do it and to staying the course is what makes, in my opinion, the difference. And the last point, and you mentioned about this meeting, I think there's been a lot of learning that I also have taken away by interacting with the ecosystem. The more you can interact with more people, there's always learning there. There's something that sparks a thought. There's something that, says, hey, that makes sense and maybe I should try it. And a lot of my personal learning has also come from just interacting with different people. It could be customers, it could be employees, it could be people in an organization or a meeting like this. It could be bankers, it could be, anybody, right? And I think the more you can interact with the outside world, as opposed to just staying within the company and just trying to figure it all out, getting an outside perspective actually opens up those eyes and knows, you get to know what you're doing right and what you're doing wrong and what is happening outside in the world. I think those are the, some of the things that in my perspective have worked well.
Arun,
that'll be my suggestion.
Just to add to that very specifically, raising small money is always a hindrance. The moment you talk multi-million, it's an easy deal. So how does that, a 10 lakh, a 15 lakh, that kind of funding. So I completely agree with you, being a serial entrepreneur myself. It's there that there is a lot of angst. I think my submission would be one about awareness, because there is already a lot of schemes and with this particular government in the last 4 years, like this M&A genome that we have started, we've registered in the Startup India. And we immediately got a certificate. We said it is innovative, artificial intelligence. So we actually have a lot of proactive mechanisms also there. So I would strongly, first of all, congratulations, sir, on coming all the way from Coimbatore and talking about innovation. But I think the crux of the matter is there is help available. Absolutely. We need to go seek it. And it can be any type of forums. Absolutely. But don't go to large forums and ask for small money.
Sure.
There is a mismatch.
So, thank you so much. So, there's really, two entrepreneurs on the stage responding. Thank you so much. So, in fact, I would like to take the opportunity to thank the entire panel. Thank you so much for being a wonderful panel. Please just step in front. We will give you some mementos. Sage from Basis, while we take a snapshot of the panel. If you could come on down. Thank you, Sage. So, as we'll have a photo op, please. If you just step ahead of the thing. So, hold on. So, yeah, go ahead. Thank you, Sesh. So, I'll just, in terms of addressing this entrepreneur's question, just go on to ventureintelligence.com. Right on the top, you will find a For Entrepreneurs link. We have a freely downloadable directory of all early stage investors in the country, right from angel investors to incubators, all the way to SME funds, right? So, that's a free resource available for you to download, and also this very important class of investors called the impact investors. So that's very important too. So please do utilize that resource that's available on our website for free. Thank you. So Sesh.